These and all other managerial accounting problems can be found in Sarai's studies. The link is in the description box below. The following data relates to Claire's company for the year 2021. So we have all of these costs, and they're asking us what is the cost of the goods sold for the year. So I'm going to pull up my inventory system. So remember, we have 3 inventory accounts: direct materials, work in process, and finished goods. And then I have my cost of goods account here as well, because I want you to see how the inventory system plays into cost of goods sold, but it is not an inventory account. So every inventory account has a beginning inventory and an ending inventory. But because cost of goods sold is not an inventory account, it just has a beginning balance and an ending balance. Remember, every account has something that increases it and something that decreases it. For direct materials, purchases of more direct materials increases the account. Usage of that material decreases the account. This usage of direct materials goes into the work in process account as direct materials because you're currently in the process of using that amount worth of direct materials, along with direct labor and overhead. What decreases the work in process account is the cost of the goods that are no longer in the process of being made, so those are the costs of the goods manufactured. Now, once you have those goods manufactured, they're done, they're ready to be sold, so you have the cost of goods available for sale or goods available for sale, like Sahey does. I do cost of goods available for sale. And then what decreases the finished goods account is the cost of the goods that were sold, because they're no longer finished goods because you don't have them anymore because you sold them, and that goes into cost of goods sold. So then you plug in what you have. So we have a beginning inventory for work in process is $50,000. We have ending inventory for work in process is $60,000. Remember, I know it's beginning and ending because I see January and December. Direct materials used is $40,000. This number is always this number. Total manufacturing cost is $72,000. Remember, when they tell you total manufacturing costs, think of the chart. Manufacturing costs are made up of direct materials, direct labor, and manufacturing overhead, or OH. We're told that total manufacturing cost is $72,000. Manufacturing overhead is $20,000. And we're told that direct materials used is $40,000. So then if we know this has to add up to this, then let's just do this minus this to get the remaining part. That's going to be $12,000. So now I know that this is $12,000, this is $20,000, and if I do the math, that's $122,000 when I add up the debits. We know that debits and credits have to balance, so this side has to also be $122,000. Do minus $60,000 to get cost of goods manufactured. So that's $62,000. This number is always this number. We have that beginning inventory for finished good is $20,000. We have that ending inventory for finished goods is $32,000. So we add up the debits, so that's going to be $82,000. Debits and credits have to balance, so this has to also be $82,000 minus $32,000. That means that cost of goods sold is $50,000. That goes here, and that is our final answer. So the cost of the goods sold for that year is $50,000, and that is the flow of the inventory costs.